Well, confidence has certainly returned to markets and sentiment has improved, but underlying anxiety still remains. And if the data was to soften, we could easily see higher volatility across financial markets. We have a look at some of the data points that you need to have on your radar, some of the event risks that come through, and how that may play into different trades in FX, equity markets, crypto, and commodities as well. So stay tuned. This is the trade-off. Hi there, Chris Weston from Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics, and we're going to be discussing the charts that matter, the moves and the shakers coming across financial markets, the trades we like, and the setups front of mind. Mr. Blake Morrow, how goes it there, sir?
I'm doing great, Chris. Good to see you. I see you're in a different location, or might be in a different location, but you look good.
Thanks, man. We're just taking it back to Castle Weston at the moment. But yeah, back in the studio next week. But you know, obviously we're mobile, we're transport, we're embracing technology and living the technology dream, mate. So yeah, it's good to be here. But look, markets are evolving. There's a lot going on. I feel like we're in this sort of fair value at the moment. Volatility is probably a little bit better priced. You know, we're just waiting now really to see how this all goes down. You know, and I think we've obviously got a much cleaner structure coming through in financial markets. So it's a really interesting time. We could go either way, you know, and I think it's probably a great time to explore where the path of least resistance and where we feel like the market may want to go. So yeah, let's go and explore this, Blake. Let's go into take the market's pulse. Right, you know, obviously we're talking about short-term moves in financial markets. There's two things that really spring out. One is flow and the other one is sentiment. So I think it's a really good idea just to understand the sentiment that we're seeing in markets right now, Blake. Obviously last week on last Monday, yeah, the heavens were collapsing. Everything was dark, sinister. You know, the market had gone into some extremes, obviously driven by a lot of flow and liquidations and forced selling that it's obviously exacerbated the move down. But I think now we've got the VIX at 16%. It's come down, you know, from much higher levels. It's still above the sort of year-to-date average, but it's much more contained levels. You know, you're seeing the advanced decline line on the S&P moving higher every day. Working quite well. Cyclicals are outperforming defensive. High beta stocks are outperforming low volatility names. Large caps are still outperforming small caps, but you know, we are seeing a better confidence coming through in terms of lower volatility. You know, more cyclical plays are outperforming. You know, it's not particularly breathtaking, but yeah, we are seeing a more confident market, a much more calm market. So how are you reading that?
Well, I think sentiment, the way you read it is, it was perfectly put. And you remember last week we pulled up the VIX chart, and is the VIX CFD that you guys follow there, Pepperstone. Once it dropped through 21, I mean, it's been nothing but blue skies and rainbows and unicorns since then. Chris, and sentiment has improved quite a bit. You know, I think we can all celebrate. All of us can celebrate Mountain Day in Japan, since they were celebrating that on Monday. So we didn't have to get up Monday morning facing a 12% down market in the Nikkei. And that just, again, increased sentiment too. So blue skies, sunshine, rainbows, unicorns, and sentiment has improved. Volatility is down. But I think you bring up a great point. These are levels that I find extremely interesting. And you guys have to make sure you stick around, because we're going to talk about a lot of these inflection points that we currently sit at. Sentiment, though, is great. I mean, look at how the markets have responded to the inflation data, or lack of inflation data, that we've gotten here in the U.S. You know, disinflationary pressures continue to ease, or did I say that correctly? Inflationary pressures continue to ease. Disinflation continues to show up in our data, which is bolstered, you know, the idea that there's going to be some rate cuts. And that goes into our next topic, Chris, rate cuts. It seems, you know, we just came off the RBNZ. They cut rates. Mexico cut rates. We're going to have Norges Central Bank. I don't think they're going to cut rates overnight, but most central banks are moving in that direction. You're getting the market starting to price in fairly aggressively that the Fed might cut maybe even 75 basis points to the end of the year. So where do you stand with rate cuts and how central banks have shifted quite rapidly over the last 2 weeks? What are your thoughts here?
Yeah, I thought you were going to say 75 basis points at the September FOMC meeting, and I was
No.
but yeah, look, I mean, I think you are seeing a more sort of synchronized cutting cycle emerge here. Obviously, the Bank of England recently cut by 25. Japan, obviously, on the other side, but they've even made out now from the deputy governor there saying that they're not going to raise rates. Whilst we're seeing market volatility in the Nikkei and the topics and the yen, so markets have pared back any kind of rate hike expectations there. But yeah, I mean, look, I think the market's bull case is that we see the Federal Reserve cut 25 basis points. I mean, I think that's a positive scenario. I think if we're in a position where they need to cut 50 basis points, that may be, in theory, that could be good. You're taking the Fed funds rate down more aggressively towards the neutral rate. But I think there's a balancing act between easing and sending concern signals to the market. And I think the Fed really only want to cut 25 basis points. I think they want to be in that position that they don't need to cut by 50 basis points. They can just gradually break the Fed funds round down. And so I think 25 basis points with a bias in September, I know it's a long way away, that they're going to ease again, that kind of dovish cut, so to speak, I think would be the Goldilocks scenario. I think if they go 50, we'll see what the data comes out between that point. I think that could send some shockwaves. But look, we've got, we've got just over 4 rate cuts being priced in by the end of the year. That feels okay. Where's the trade? Is there a trade there for you, Blake, in the rates markets?
Well, I don't know. And this is where we're going to have to start looking at all the event risk and the data that's coming. I mean, next week we're going into we've got Jackson Hole, which is going to make us all jealous that we're not there. And by the way, I've never been to, yeah, I've never been to that symposium. I don't ever plan. I do plan on visiting Jackson Hole at some point. I spent some time in Montana, beautiful country. I mean, just beautiful, beautiful country. Anyway, I digress. There's still a lot of data between now and then, and I think you guys over at Pepperstone, you guys put together a really nice schematic showing all the different event risk over the course of the next couple of months for the Pepperstone clients. So, what do you see on the horizon, Chris? Kind of going back to rate cuts. Like I'm looking at all the. It's going to be a cumulative of data, but we got to look at really the jobs data, starting with tomorrow's weekly unemployment claims. But with that, we've got JOLTS data. We got non-farm payroll, another non-farm payroll coming up before the next Fed meeting on September 18th. So there's some labor data that I know the market's really focused on because they know the Fed's really focused on it too.
Yeah.
But, yeah. So what are you thinking here as far as the event risk that could influence more rate cuts or different play on rates? Because I personally feel, just to answer your question, I think the market is aggressively pricing rate cuts, and I don't think the Fed. I'm similar to you. I don't think the Fed needs to act in that fashion. I don't think they need to be super aggressive. They don't have to pull a Professor Spiegel. Spiegel, is that his name? Spiegel. One at Wharton. Anyway, the one that freaked out on CNBC the other day.
Very quickly, didn't he?
Yeah. Oh, it was pretty funny. He actually got called out by the host today about his freak out on 75 basis point surprise cut. Anyway, needless to say, I think the market's getting a little too excited about rate cuts, and so I think that could support the dollar. But where you stand as far as the event risk coming up and where rates are at right now?
Yeah, I think the Fed have made the dual part of their mandate or brought it back into fashion. It's less about just the inflation side of things, and it's now labour market and inflation. So yeah, I mean, the weekly claims were number. If it was to push above, nicely above 240,000, then that could cause some anxiety. The jolts maybe. But yeah, I think the payrolls number on the 6th of September is going to be the next big one there because, that was weak last month. Some people have said that's down to weather-related patterns and some other factors. And we'll see then. Obviously the unemployment rate's going to be really important there. So the 6th of September is the big one. We get core PCE, the inflation number that the Fed look at. That comes out at the end of the month on the 30th. Now, we've had the components from the PPI and CPI, and we're sort of running that, 18 basis points month on month, and that sort of equates to a year-on-year pace of about 2.7%. So a slight pickup. So we'll see that, but that's enough for them to, if we're to come out there, that's still enough for them to cut by 25 basis points. Then you go into the growth data points, which on the chart, we've sort of broken it down into labour, growth and inflation. And you've got personal spending, you've got ISM manufacturing and services numbers coming out on the 3rd and 5th there. So I think they're the data points. I think payroll's number, but Jackson Hole next week, obviously he's going to pre-guide a rate cut there. And of course, we've got the DNC next week. We've got the Democrat National Convention where, obviously they're going to show a very galvanized point. And, I think the election will become a big thing. We'll start trading the election probably, from the 3rd of September, the day after Labor Day in the US. I think it's the day that everyone's saying is shit gets real there. So, we're going to be looking at some trades around that and sort of reacting more to the polls. Quickly, while I've got you though, Blake, those are the data points that I think the market needs to see, and we are going to be data dependent. So if the data rolls over, I think risk goes lower. If the data seems is better, we'll get the 25 basis point price, but we'll pull back recession trades and equity screams higher. So what do you see now? Where's the next 5% in the S&P and the Nasdaq, higher or lower?
Yeah, that's a great question. Well, you're going to soon see in some of the setups that I bring you. I'm going to be a little biased at this point, but I feel it's actually lower right now. I think the next 5% is actually lower, not higher. I don't think we're going to all-time highs. I think we are going to create a lower high. But again, just as you pointed out, we really have to see the data, and the data is going to be driving it. And remember, there's risks. There's going to be the election risk is hot and heavy. And don't forget, we still have geopolitical risks too. I know there's talks right now in the Middle East that's probably one of the things that's put a bid underneath the markets. But if those talks fall apart, forget about it. This market will probably come under pressure really quickly. On top of that, you've got Ukraine, Russian situation that's also picking up a little bit of steam because obviously winter is coming. So, that activity is picking up now before it gets too cold. So there are a lot of things that are still that are in play right now. And I think if you're blindly buying risk at the moment after a nice sizable bounce, you have to be a little careful here. So what are your thoughts?
Quickly, we've just run out of time, but I think for me, where the trade comes in is when we start seeing markets looking to chase the upside. And I think I'll jump on that. At the moment, we've had a 10% rally in the Nasdaq futures from the lows. It's a good place to be, but now we're just waiting for the data. I don't know whether the data's going to come in better or worse, but we'll react. And if it does come in better, then I think your CTAs start going long again in the market. You get the vol targeting funds who have really come out of the market, starting to add because realized volatility to be lower. And then that's when you start talking about new all-time highs, and that's where you can chase it. But we're just in this hiatus at the moment, waiting for the data. But the technicals matter, price action matters, and so let's go to that's the setup and have a look at some of the charts. I'm going to go first, Mr. Morrow. I'm going to go for dollar yen. Now, it obviously was very influential last week. We were talking about it non-stop. People talking about the yen funded carry trade. Carry's working a little bit better now. I mean, it's still too early for me to be really feeling like carry as a strategy is going to be working. Volatility's come down. Great. We love low vol to go on the carry. We know the Bank of Japan have told us they're not going to be looking to raise rates in high volatility markets. Good for carry. But also, we need to see positively trending equity markets. You want to be in carry when, you can get the capital growth, but you can get paid to be in the position. So we're not necessarily seeing that just yet. They've bounced, but they're not properly trending. And for that to happen, for the yen to materially weaken, I think people getting back into the carry of confidence, we need to see those three dynamics playing out. But what we've seen here, and it's similar to a lot of charts, go and have a look at the KRE banking index. Have a look at there's a whole raft of different charts that look very similar to to dollar yen at the moment. But we've had obviously a nice move down. We've pulled back up, but we're just consolidating here. So it's a really interesting one at the moment. It's not a trade that I'm in. But I want the market to reveal itself. If you start seeing a breakout from this consolidation range with rate of change moving up, I'm jumping in. But then again, I think it's really down to what happens in 2-year Treasury yields, comes in the data. So another one of those kind of wait and see markets. We're just waiting for this data to come in. Maybe retail sales helps us out tonight, jobless claims. But look, really had a nice melt up. We're just consolidating. It's hit a fair value in the market. The market now wants to see new news before making that next step.
Just one other thing I want to mention just regarding the yen that might be something to pay attention to over the next couple of weeks. Prime Minister Kishida is not seeking re-election, so you got to start thinking about who the next leader of Japan is going to be as prime minister, and what their thoughts are on monetary policy. One of the front runners, Bloomberg ran an article about one of the front runners that is more pro monetary policy normalizing. And so those are things that we as currency traders will be thinking about in the weeks ahead. But I'm going to take you over to Ethereum. It's not speaking of a chart that looks kind of like the dollar yen. Take a look at Ethereum, and we had a very similar bounce and consolidation, but this is a great setup for a couple of different reasons. If you look at the big leg, when we made a lower high back in May, I guess it was May of this year. Yeah, it was about the end of May. We made a lower high. From that high down to the most recent lows, post ETF launch, so on and so forth, we've only bounced to a 38% retracement, Chris. And so this chart is very, very clear from a setup perspective, because you can see all those spike lows going all through 2024, the lows that were back in April, the lows were back in May, the spike lows back in July. We are basically retesting those levels around 2800, 2810, 2810, right around there. If we break above that, that's going to be a bullish setup going, obviously you're going to get a squeeze, but we've consolidated for the last couple of days below 2800. This could be a good risk reward setup for a potential short. So I like the setup for a short unless you break back above 2810, but I thought it'd be something. I know a lot of your traders at Pepperstone, they like to trade crypto, and I think crypto could give you a little bit for both bulls or bears here.
Yeah, cool. I want to take over and have a look at the 2-year Treasury. Now, it's not technical in nature, but I think this is quite an interesting one. So what you've got at the top there is the 2-year Treasury. I've just got it as a line chart, obviously, just to give you a sort of oversight. And that has come off from around 5% to current levels. It's been a decent move lower as traders have bought into the front end. Now, if you look at the lower chart, what I've done is I've taken the Fed funds rate, the effective rate, which is effectively the price of money. This is where short-term money market rates trade. This is what the Fed guide to when they're setting policy by having an upper-lower band. And if you take that level away, what we call the effective rate from the 2-year Treasury, we can see that currently trading at 137 basis points. So basically, the 2-year Treasury is trading with a yield 137 basis points lower than where the current Fed funds rate is, the effective rate. Now, that tells me that the market is, we can look at what's being priced in terms of rate cuts over a certain period. But I like to look at this as a sort of a beacon to understand that the market is saying that Fed policy is too tight for current levels. The higher this goes, basically it means, the market is pricing in further rate cuts. The higher this goes, that bottom pane, which you can do on TradingView as well. Basically, what that tells me is the market is saying increasingly that the Fed policy is too tight for where they see their ambition for the economy, for inflation, for growth. And the higher that goes, the more that the market is saying the Fed need to cut. So I use this as a bit of a beacon, a bit of a guide to understand how the market is pricing Fed expectations and the need for them to get rates down to a more neutral setting so that they don't cause a recession. I'm not sitting in the recession camp at the moment, but so I like to use that. I think that's just a sort of a more education view. Get the effective rate, substitute or subtract the 2-year Treasury, and I like to use that to understand how the market's seeing the Fed needing to take action there.
Well, that's going to tie in really nicely to my last setup, Chris, which would be the dollar index. And I'm asking the question: are we ready to break down? I mean, this is the ETF or the CFD, I'm sorry, that you guys have for the dollar index over at Pepperstone, which really mirrors the dollar index almost to a T. You can see the support coming in right around, I'm going to call it about 102.15, 102.20. We break below that, and there's a little bit of a trap door. I think there's an opening for a move back down towards 100. Now, the reason why I bring up this chart is this: if you use the euro dollar, and the euro dollar makes up over 50% of the dollar index itself, the euro/US dollar, it's breaking out above 110, and it's comfortably above 110 at the moment at the time of filming. And it looks like the euro could make a move for higher 110s, maybe even 111 in the days ahead. If that is truly the case, that means the dollar index is going to break down, and the dollar index will break through this triangle support. If it breaks through this triangle support, there's a whole swath of dollar pairs you could be looking at, one of them being the Aussie dollar. Maybe even the Kiwi dollar might recover a little bit after its rate cut less than 24 hours ago. So there's a lot of things to look at, especially if the dollar index breaks down. But I think this is a really critical support that we're sitting on today, right now, at this moment.
It's interesting you brought the RBNZ and the Kiwis there. I think that was quite intentful. Cut 25 basis points, but they also told us that, on a positive note, that they're having more confidence about getting to their inflation targets. But they said that they're in a really tough spot in the economy at the moment. Obviously, a massive exodus from the country, mass migration taking place. People are struggling to find jobs. There's a lot. House sales last month were down 25%, and they talked about the idea that they were toying with the idea of a 50 basis point cut at this meeting, which is part of the reason why we saw such a big move down. The market was not expecting that. So it feels like to me that the Kiwi dollar's got some further downside, but you'd probably do it on a relative basis against some of the crosses. That was quite an impactful statement that we heard from the RBNZ. So yeah, really watching that Kiwi dollar very closely from here. But anyway, let's go to the player of the day. Hi there. Player of the day. Last week I was looking at Tesla. Still in the trade. It's sort of up a couple of cents really since last week. Hasn't really done much, which is frustrating. But that's the market. So still in the shorts there. This week I'm looking at WTI crude. As you can see, we've been in a consolidation triangle for quite some time, and that really needs to play out. But the market at the moment is just having sort of less emphasis to push it higher, push it lower. There's a bit of a battle going on. So, like dollar yen in a sort of a bigger picture here, we've kind of hit a fair value with the market. Pretty comfortable with where it is at the moment. That said, you can see that orange sort of rectangle, which is been a really good supply zone recently. And we saw markets fade into that level, bounce back, sort of roll over. And we just see a slightly higher inventory report that came through. Now, obviously, from a fundamental perspective, you've got this two-way balance. You've got the International Energy Agency coming down and lowering their demand forecast because of lower growth from China. Obviously, that didn't really impact at the time because we were seeing sort of geopolitical tensions playing through around Israel and Iran and various parts of what's happening in Ukraine as well. But obviously, that's now rolled over. The market's sort of a bit more comfortable with the idea that we're not going to see the gas being turned off between Russia and Ukraine into Europe. But it's rolled over a little bit, come down. I want to play this by looking to do sell stop orders below that yesterday's low. Just so that if it does kick lower, we're taking that down and hoping to ride the momentum. So I'm not in the trade yet. I've got a stop order to sell below yesterday's low. And what we're doing then is we're using a momentum strategy. If it takes that low out, you're hoping that it kicks on down to the trend support.
All right, Chris. Well, you asked for it, so I'm going to show it. And I want to show the Kiwi yen. That is going to be my play of the day. And, this is funny. It's the exact same setup as last week when I talked about the Aussie yen. You guys might remember that play of the day. And I said, while below 98, I hate. Well, the high this week has been 97.95, and it's come off since then, and it's come back down towards 97. And same play, same setup, different central bank. I was just reading from a U.S. bank that's pricing in the RBNZ to be at 3.5% from where we're at right now at 5.25. That's 175 basis points of cuts through the end of 2025. So when you say there might be some extra downside room for pricing in the Kiwi, there might be. With the New Zealand yen, you'll notice where we stopped. We stopped at the 38% retracement. That's at 89.19. The trend line, that blue trend line that you see there, that goes from the COVID lows, the spiked lows, all the way to current prices. That caps us right around 90. So basically, while below 90, I like it for a short, just like the Aussie yen, while below while below 98. I like to hate. Well, in this case, while we're below 90, I'm expecting lower prices in the New Zealand yen. And I just established a short today, right at current levels. So play of the day, I'm actually playing it. And I'm playing the Aussie Yen too. So just so you know. But Chris, you asked for it. You got it.
Skin in the game, brother. Like it. Brilliant. Cheers, Blake. Thanks very much. And for everyone at home, thank you for joining us. Leave your comments in the field. If you've got anything you'd like us to talk about, by all means, let us know. And hit the like button, subscribe where you can, and tell your friends and family about the show. We'll see you next week on the training.